Welcome to the Deep Dive, the show that extracts the most important nuggets of knowledge from sometimes pretty dense sources. Today, we're diving into a giant, a company that, well, still powers something like three-quarters of the world's main data center workloads. We're talking Intel.
That's right. And their foundational role, it's undeniable. But, reading through their 2024 annual report, the Form 10K, it really paints a picture of a company, well, needing to, as they say, up their game.
So that's our mission today, right? Unpack that report.
Exactly.
Yeah.
We'll look at their business segments, how they're changing, dig into the financials, the performance, understand the strategic pivots they're making, and try to assess, where they're headed in this incredibly tough market.
Okay. So if you're curious about the future of computing, AI, maybe even global tech supply chains, this is definitely for you. We're going to pull out the key stuff quickly and clearly from, well, hundreds of pages. Let's get into it.
All right. So Intel's core identity. Fundamentally, they design and manufacture semiconductors. CPUs, of course, are central. And this happens through two main arms now. Intel Products, which sells the chips, and Intel Foundry, which is their big push into actually making chips, not just for themselves, but for others too.
Yep.
It's their IDM, their integrated device manufacturer model, but kind of on steroids now.
And they talk about these superpowers driving demand. It sounds a bit like marketing speak, but what are they getting at?
Well, yeah, the term might be flashy, but the concepts are real. They list 5. Ubiquitous compute, meaning compute everywhere. Pervasive connectivity, cloud-to-edge infrastructure, AI, obviously, and sensing.
Okay.
And the key thing, they say, is that these aren't isolated. They amplify each other.
Huh.
Like more connectivity enables more edge compute, which generates more data for AI, which needs more powerful chips. It creates this constant upward pressure for more processing power on smaller chips.
A virtuous cycle, as they put it.
Yeah.
Makes sense.
Exactly. And it means it's not just about CPUs anymore. They're really pushing what they call the XPU approach.
XPU.
Yeah, think X as a variable. So beyond the CPU, they're delivering a whole family of processors. GPUs, naturally,
Yeah.
for graphics and parallel stuff. IPUs, infrastructure processing units.
Right. You mentioned those,
Yeah.
like offloading the data center chores.
Precisely. Freeing up the main CPU. Then you have FPGAs, those reconfigurable chips, and other specialized accelerators. The idea is different jobs need different tools, and they want the whole toolkit.
And AI is clearly the big driver behind a lot of this diversification.
Oh, absolutely massive. And their strategy isn't just the huge cloud models. They want AI where the data is being generated and used. So AI in the cloud, sure, but also AI PCs, AI at the edge. They're aiming for open modular solutions that scale across that whole range.
Okay, let's drill down into those product segments then, starting with CCG Client Computing Group. That's the PC stuff, right?
That's the one. The PC market, after a pretty rough patch, seemed to stabilize a bit in 2024. Intel sounds fairly optimistic long term. They point to stable PC ownership, room to grow in education outside the U.S., and this big commercial refresh cycle. Apparently over 200 million business PCs are over 4 years old.
Wow, that is a big potential upgrade pool. But man, the competition there is just brutal, isn't it? AMD is strong, and then you've got the ARM players like Apple's M series, Qualcomm's Snapdragon.
Brutal is the word. And Intel themselves say they expect it to get even more intense in 2025,
Oh.
especially with all these AI-focused chips coming online.
So what are they doing about it, product-wise?
Well, they're leaning hard into the AI PC. In 2024, they ramped up the Intel Core Ultra Series 1. That's their first chip with an integrated NPU, a neural processing unit, right on the chip for local AI tasks. And significantly, that's made on their own Intel 4 processor.
Their own new tech. Okay.
Right. But then they also launched the Intel Core Ultra 200V series. This one focuses more on power efficiency, uses their Xe2 graphics. But interestingly, it's made by an external foundry.
Ah, so they're using competitors, essentially, to make some of their chips.
When it makes sense, yeah. Yeah, it shows that hybrid approach. So performance-wise, for CCG in 2024, revenue was actually up 4% from 2023, mostly driven by more notebook sales, which is good news for them, though desktop revenue was down, and they exited some older businesses.
Okay, so a mixed bag, but slightly positive for CCG. What about the big iron, data center and AI group, DCAI?
Right, DCAI. The driver here is just this insatiable appetite for data insights. And AI is everywhere now. Intel definitely benefits from having that huge installed base of Xeon processors already out there.
But they can't just rest on Xeon, right? Given NVIDIA and
No
others.
way. They're actively expanding their portfolio of more heterogeneous compute, combining CPUs with IPUs, AI accelerators, future GPUs,
Hmm.
and they highlight differentiating features in Xeon itself, like AMX for AI acceleration, SGX for security, crypto acceleration, trying to add value beyond just raw cores.
And new Xeon chips came out in 2024.
Yeah, the Xeon 6 line, it has two main flavors. E-cores, or efficient cores, for things like cloud microservices where you need lots of cores that don't draw too much power, and P-cores, performance cores, which have built-in matrix engines specifically for heavier compute like AI. They're also pushing specific chips for the edge, retail, manufacturing, healthcare.
And the networking side within the data center. You mentioned IPUs again.
Yeah, their networking gear, NICs and IPUs, is based on open standards. The IPUs are interesting because they handle infrastructure tasks, networking, storage, security, freeing up the main Xeon CPUs to just run the applications. It's about efficiency and security.
But competition here in DCAI is, if anything, even tougher than in PCs.
Oh, absolutely. You've got AMD hitting them on CPUs, GPUs, accelerators.
Yeah,
NVIDIA is, well, NVIDIA dominant in AI training GPUs. And then the big cloud providers are increasingly designing their own custom chips.
right, the hyperscalers.
Exactly. And there's been a clear shift in spending towards GPUs for AI workloads. So despite all that, DCAI revenue did edge up 1% in 2024, mostly because they sold more expensive high-core count chips, which pushed up average selling prices, even though the actual number of chips sold, the volume, went down.
Interesting dynamic. Higher prices, lower volume. And briefly, the networking and edge group, NEX.
Yeah, NEX is part of Intel products too. Pulled in about $5.8 billion in 2024. Still significant for those specialized network and edge deployments, like 5G infrastructure and IoT.
Okay, let's pivot now to what feels like the biggest strategic gamble, Intel Foundry.
Gamble's a good word. It's monumental. Their stated mission is nothing less than delivering world-class systems foundry capabilities, not just for their own internal needs, but crucially attracting external customers. They want to be, quote, stewards of Moore's Law.
Big talk. What do they claim are their advantages in becoming a foundry?
They point to their design ecosystem, their ability to do systems of chips, integrating chiplets into advanced packages, and offering a secure, resilient, and sustainable supply chain with more focus on U.S. and Europe capacity.
But building these cutting-edge fabs costs astronomical amounts of money.
Astronomical is right. The capital intensity is staggering. They note that only a few companies worldwide are even attempting 2-nanometer lithography. Intel is one of just 3, and this is where their internal volume becomes critical. Having their own products use the fabs provides scale, which they argue helps de-risk the whole foundry offering for outside customers. It's the anchor tenant argument.
So what are they actually offering potential foundry customers?
It's 4 main things. Wafer fabrication, obviously. Advanced packaging connecting chips together in innovative ways, selling chiplets as modular components. And then software and services to support it all.
And how do they plan to stand out from TSMC or Samsung?
They're banking on leading-edge packaging, like Foveros, and their process technology roadmap. Ribbon FET, PowerVia, these are new transistor architectures, plus their node pipeline. Intel 18A for 2 millimeters, then 14A, plus the existing 3, 7, 16 nodes. They also stress having capacity in the US and Europe, which is a big geopolitical selling point now, and their IP portfolio, including by 86 cores. They're even partnering with UMC on a 12-millimeter process.
And the timeline for this cutting-edge stuff?
They're aiming for volume production on Intel 18A, that 2-millimeter node, in 2025. That's incredibly aggressive. It signals how badly they want to reclaim that process leadership crown.
And they're spinning Foundry out, sort of?
Yeah, the plan is to make Intel Foundry an independent subsidiary.
Ah.
The idea is clearer separation, make external customers feel more comfortable, maybe you attract separate funding down the line. It addresses that potential conflict of interest issue.
Makes sense. But the competition is fierce. TSMC, Samsung.
Giants, plus Global Foundries, UMC, SMICAC, it's a tough crowd. And for 2024, Intel Foundry's reported revenue was actually $17.5 billion, down $1.4 billion from 2023, mostly due to lower pricing internally and a really sharp drop, 60% in external revenue from things like traditional packaging services.
Okay, so the Foundry is a work in progress, clearly. Let's shift to the overall financials. How did Intel do in 2024, top line?
Consolidated revenue for 2024 was $53.1 billion. That's actually down slightly, about 1.1 billion or 2% compared to 2023.
Down 2%. Why was that?
Well, the main drags were a big 32% drop in their all-other category. Think Altera, Mobileye customers cutting back inventory, and that 60% plunge in Intel Foundry's external revenue we just mentioned. Those were partly offset by a 3% rise in the Intel product side, from CCG and DCAI doing a bit better.
Okay, but gross margin. That seemed like a really dramatic story.
Oh yeah, that's where you really see the pressure. Consolidated gross margin fell off a cliff, down $4.4 billion, or 20% compared to 2023. It ended up at 42.6%.
Awesome.
Compare that to 50% in 2023 and 51% the year before. It really shows the cost of this transition.
A drop from 50% to 42.6%. Why such a steep decline?
Several big reasons. A massive $3.3 billion hit from non-cash impairments and accelerated depreciation on manufacturing gear, mainly for the Intel 7 node as they kind of reassess things.
Yeah.
Unit costs went up because they're making more of the newer, initially more expensive Intel 4 and 7 stuff. There was almost $1 billion write-down related to Gaudi AI accelerator inventory and just huge factory startup costs for these new fabs.
That sounds painful. Were there any positives helping the margin?
Some minor offsets, yeah. They sold some inventory that was previously reserved, had lower charges for excess capacity compared to the prior year, and got some benefit from those CHPS Act government incentives. But, and this is a big but, they have over $50 billion tied up in construction in progress. When those factories come online, that's going to be huge depreciation expenses hitting the books down the road.
$50 billion. Wow. Okay, so that brings us to the bottom line. Net income or loss?
Loss, a big one.
Yeah.
A net loss of $19.23 billion for 2024. That's a huge swing from net income of $1.7 billion in 2023 and $8 billion in 2022. Earnings per share went from positive $7.40 in 2023 to negative $4.38 in 2024.
$19 billion loss. What were the biggest drivers beyond those margin hits?
Well, beyond the $3.3 billion of cost of sales charges, there was another $3.1 billion non-cash goodwill impairment, mostly tied to Mobileye, and a really substantial $9.9 billion non-cash charge for income tax valuation allowances, basically accounting adjustments reflecting a bleaker near-term profit outlook.
Okay, so with losses like that and massive spending, what does their cash situation look like? Liquidity.
Yeah, you look at the balance sheet. Total cash and short-term investments were about $22 billion at the end of 2024, down from $25 billion the year before. So cash is going down, and total debt edged up slightly to just over $50 billion.
Less cash, more debt. How about cash flow from operations? Are they generating cash?
They generated $8.3 billion from operations in 2024, which sounds okay, but it's down from $11.5 billion in 2023. The net loss hurt, obviously, though non-cash charges like depreciation helped offset that somewhat. But the really critical number here is adjusted free cash flow.
Right. Cash from operations minus capital spending, essentially.
Basically, yeah, with some adjustments. And it's been negative for 3 years straight. Negative $2.2 billion in 2024. Negative $11.8 billion in 2023. Negative $4.1 billion in 2022. That just screams massive investment outflow, spending way more cash than they're bringing in from running the business.
So where is all that cash going? Capital expenditures must be huge.
It's huge. $23.9 billion in CapEx in 2024. Slightly down from $25.8 billion in 2023, but still enormous. And remember that $50.4 billion in construction in progress we talked about, that's future spending becoming assets.
How are they funding all this if free cash flow is negative?
It's a combination. Cash from operations helps some, existing cash reserves, debt, obviously. They have credit lines. But critically, it's these smart capital initiatives.
Right, smart capital. Let's unpack that. It's not just about asking for government money, is it?
No, it's a multi-pronged approach to try and lessen the direct cash hit on Intel's balance sheet. So yes, government incentives are key. Under the U.S. GPS Act, they've got commitments for up to $7.9 billion in direct funding, plus another $3 billion for a secure chip program. They already got $1.1 billion cash in 2024.
Okay, that's significant. What
Yeah.
about private capital?
That's the other big piece. They've done deals with private equity, a big one with Apollo related to their fab in Ireland. Brought in $11 billion net cash. Another with Brookfield for their Arizona site.
Intel expects these kinds of partnerships, plus government money and maybe customer prepayments for foundry capacity, to offset more than $25 billion in capital costs overall.
$25 billion. That's a serious offset.
Yeah.
Okay, so with all this focus on investment and negative free cash flow, what does that mean for shareholders directly? Dividends, buybacks?
Well, historically, Intel was a reliable dividend payer and did buybacks. That was the playbook for a mature tech giant.
Was past tense.
Definitely past tense for now. They completely suspended quarterly dividends starting late in 2024. And here's the kicker. The Take-Shape Act funding agreement prohibits them from paying dividends for the next 2 years and limits them for 3 years after that.
Wow, so it's not just their choice, it's mandated. Mandated by the terms of the government funding, yes. Their official line is they won't pay dividends until cash flow improves significantly anyway. The focus is 100% on investing in the strategy for long-term value.
Okay, no dividends for a while. What about share buybacks?
Same story, really. They haven't actually bought back stock since early 2021, none in 2024. They technically still have authorization left, about $7.2 billion, but they state clearly they don't expect to use it until cash flows improve. Direct cash returns to shareholders are effectively on ice.
So, putting it all together, massive strategic shift, huge investments, financial strain, no direct shareholder returns for now. How do we assess Intel moving forward? What are the biggest risks?
Well, the risk is substantial. You get sheer execution risk. This turnaround plan, the aggressive tech roadmap to regain leadership, it's incredibly complex. We've seen them stumble before with 10 millimeters and 7 millimeter delays. Any slips now would be very costly. And they've already had to slow down some big projects like in Ohio and Germany.
And the market isn't waiting for them.
Not at all. Yeah. The market and competitive pressures are intense. We talked about AMD, ARM, NVIDIA, the cloud guys building their own chips. Intel has lost share. And jumping into the foundry business against entrenched players like TSMC and Samsung, that's a huge mountain to climb, especially winning trust from customers who might also compete with Intel's product side.
Plus the sheer cost of it all.
Exactly. The financial strain is obvious. Years of negative free cash flow, piling up debt, credit downgrades, increasing borrowing costs. They also need to keep their key engineers motivated and on board through all this change, especially after job cuts. And they keep getting hit with expensive litigation, like that billion-dollar VLSI charge. It all adds up.
It sounds like a company under immense pressure, though interestingly, they still highlight their ESG commitment.
Yeah, it's notable. Linking executive pay to things like reducing emissions, using renewable energy, water conservation. It shows they're still trying to balance those broader corporate responsibilities, even while fighting for survival technologically and financially.
Okay, so summing up, Intel's making this enormous transformational bet, becoming a major foundry, huge R&D spend, massive factory build-out, funded partly by government and private capital, but requiring them to pause dividends and buybacks.
That's the core of it. They're navigating this incredibly competitive landscape, facing huge execution risks, geopolitical tensions affecting supply chains, all while trying to regain the technology leadership they once owned outright. It's a high-wire act.
A real test of whether this massive investment cycle can pay off and redefine their position in the industry.
Absolutely. Which leads to a final thought, maybe for you to ponder. Considering Intel's bold strategy, this massive investment in manufacturing and R&D, coupled with temporarily halting direct shareholder returns, what is this aggressive, multi-billion-dollar bet on AI everywhere, and building a resilient global supply chain truly signal for the long-term future of the entire semiconductor industry? How might it reshape what we even think of as technological leadership?
Something to definitely think about. We'll leave it there for this deep dive.